These dividend stocks offer investors significant income while waiting for the bear market to end. Major stock market indexes have fallen to near lows, and the Federal Reserve keeps hiking interest rates amid an unprecedented surge in inflation. This has caused investors to reassess their valuations for a whole host of financial assets including stocks, bonds, and the US dollar. Investors might be tempted to sell out of stocks given this confusing macroeconomic environment. However, historically, it has generally not been a wise decision to try to time the market. Instead, investors might seek to lower their portfolio risk by picking up more stable blue-chip companies paying large dividends. These 15 dividend stocks to buy all offer yields above 3% while having significant upside potential once the current bear market lets up. The energy sector has long been a reliable hunting ground for dividends. That's been especially true in 2022 as oil and natural gas have been among the few bright spots in the economy. Supply shortages and geopolitical uncertainty have lifted energy prices and resulting sector profits to their highest point since at least 2014. ExxonMobil has been one of the biggest beneficiaries. It kept investing in additional production in the late 2010s when so many energy peers cut back spending in new projects. On top of that, ExxonMobil held onto its refining and chemical plant assets. These are earning tremendous profits now, thanks to a boom in refining profit margins and shortages for various chemical goods within industrial supply chains. Add it all up and Exxon is still cheap, even after its big run-up over the past year. Shares currently trade for about 9 times forward earnings, and the stock pays a 3.6% dividend. Verizon Communications Inc. Verizon is one of America's 3 primary mobile phone carriers. The company also has extensive operations in fiber via its Fios division. Verizon was supposed to enjoy renewed prosperity thanks to its heavy investments in 5G and spectrum to upgrade its network quality and speed. Instead, these investments have been slower to bear fruit than anticipated. Throw in rising interest rates, which will make Verizon's debt more expensive to service, and it's understandable why some investors are nervous. However, these fears are overblown. Verizon is trading at just 7 times earnings, and earnings are stable. The company just raised its dividend, and it signaled that a buyback may be on the menu in the future as well. Shares currently yield about 7.3%. Enbridge Inc. Enbridge is one of Canada's largest energy companies. It is a pipeline operator that has focused on oil pipelines in particular and has more consistent earnings and cash flows than many of its pipeline rivals. This is in considerable part because Enbridge controls key pipelines carrying crude oil from Canada to US refining centres. This has been of vital importance given the current imbalances in the refining supply chain, along with regulatory efforts which have blocked the development of new pipelines. As projects such as Keystone 40 floundered, it has given more value to existing already built pipeline infrastructure. Enbridge maintained its dividend during the late 2010s energy bust when so many of its rivals had to trim theirs. The company now offers a 7.1% dividend yield, giving investors a huge income stream off essential infrastructure assets. VF Corp. VF Corp is a diversified apparel company which owns and operates more than a dozen brands including Vans, Timberland, and The North Face. The company is a dividend aristocrat and has raised its dividend for more than 25 years in a row. That's an impressive accomplishment, and doubly so in the clothing industry, which is known for its booms and busts. VF has achieved its results in part due to taking a venture capital approach to its industry. The company buys retail brands when they're small or struggling and then builds them up to a much stronger position before selling or spinning them off. VFC stock has lost more than half its value over the past 12 months as investors worry about inflation and the economic downturn. That has made shares a compelling value at just 11 times forward earnings and while offering a 6.9% dividend yield. Intel Corp. Intel is having a dreadful year. After the historic surge in personal computer and electronic sales in 2020 and 2021, consumer demand has plummeted. Computer sales are now down 19.5% for the most recent quarter versus the same period of 2021, according to Gartner, a tech research firm. This is a devastating development for PC chip makers such as Intel and Advanced Micro Devices Inc. Not only are sales down, but profit margins have slumped as discounting will be necessary to get rid of excess inventory. However, investors have overreacted. Intel shares are now down by more than 50% over the past year. That's an overblown move for a blue-chip stock with a business as resilient as Intel's. Don't forget that the company is also a big beneficiary of the recent government stimulus program for semiconductor companies building new manufacturing facilities in the United States. Unilever PLC. Unilever is one of the world's largest consumer staples companies. It manufactures a wide array of products covering home care, personal products, and packaged foods. Unilever had struggled to grow revenues in recent years as consumers have moved away from some of Unilever's more staid brands. However, things have changed since 2020 as consumer spending habits have shifted since the pandemic began. The inflationary environment has also given Unilever a greater ability to finally raise prices and work on the company's profit margins. Activists, frustrated by years of poor results, have also urged change at Unilever. This appears to have worked, as Unilever's CEO Alan Jope now plans to retire by the end of 2023. Combine activist investors with new management and a changing consumer spending landscape, and Unilever has a shot to reinvent itself while also paying a 4.3% dividend yield. 3M Co. 3M is an industrial conglomerate that manufactures all sorts of things ranging from post-it notes to dental tools, safety helmets and transportation equipment, among many other product lines. The company is a dividend king, meaning that it has raised its dividend for more than 50 years in a row. That's a truly incredible feat, given all the disruptions that have happened to the world economy over that stretch. Investors are once again doubting 3M. Shares are down by more than 50% from their all-time highs. Current fears include inflation, economic weakness, and product liability lawsuits, among others. These are valid concerns to be sure, but 3M has proven more than resilient in the past. Shares go for less than 11 times forward earnings today, yield 5.5%, and will benefit from the current resurgence in the American manufacturing sector. Canadian Imperial Bank of Commerce. Canadian banks have long looked relatively expensive compared to their southern neighbours. This made sense given Canada's reputation for an impeccably stable economy and regulatory environment. However, investors might have wanted to stay away given the higher valuation and uncertain footing of Canada's lofty housing market. Now, however, things are more attractive. Canada's housing market has corrected, which should reduce risk for lenders going forward. Additionally, the prices of Canadian banks have dropped dramatically, which reduces the valuation gap with American banks. CN stock has been one of the hardest hit, with shares down around 25% year-to-date through October 14th. That has pushed shares to less than 8 times forward earnings while offering a 6% dividend yield. For investors that avoided Canadian banks due to premium valuations, now is a good time to take a second look at the sector. Realty Income Corp. Realty Income is a real estate investment trust, or REIT, focused on triple net leases. These are leases where the tenant pays most operating expenses such as utilities along with capital expenditures to maintain and upgrade a property. Triple net leases are one of the better structures for real estate investment during an inflationary period due to the unique distribution of costs between the landlord and tenant. Realty Income has also built its business around stable, high-quality tenants such as Walgreens Boots Alliance Inc. and FedEx Corp. Another positive factor for Realty Income is that it pays its 5.1% annualized dividend on a monthly schedule, giving income investors a more frequent stream of payments. O stock has dropped more than 20% since its August peak, putting shares squarely back into the buy zone. Northrim BanCorp Inc. The Alaskan banking market is a unique one. There are fewer than a dozen banks that compete there, given the state's isolation from the rest of the country. Thanks to the lower level of competition, Northrim and other Alaskan banks typically earn much higher net interest margins than banks in the contiguous U.S. This structural advantage should intensify going forward as Alaska is reliant on oil income to provide royalties for the local economy. With oil prices surging, there should be more consumer wealth in Alaska, which creates better lending conditions for Northrim. The bank is already enjoying solid operational results. Shares trade for less than 7 times forward earnings, and the bank boosted its dividend 22% in August. Shares now yield for 0.5%. Dow Inc. Dow is the world's third largest chemicals company. The company's present form came about after a series of mergers and an eventual spin-off from DuPont Dynamos Inc. Dow makes chemicals for a massive array of industries including energy, packaging and specialty plastics, coatings, construction materials and consumer solutions, among others. Chemicals are viewed as a cyclical industry with low profitability. However, Dow outpaces many rivals because of its massive operational scale and its proprietary products. Dow has a new advantage of note as well. It operates largely from the United States and thus benefits from America's relatively cheap electricity and ample supply of natural gas and other chemical feedstocks. This makes a big difference versus European rivals such as BASF, which are struggling with gas shortages and high electricity prices. Dow stock is selling for about 8 times forward earnings while offering a 6.4% dividend yield. Suncor Energy Inc. Suncor is one of Canada's largest energy companies. Importantly, it isn't just an oil and gas producer. Independent Canadian oil companies often have to accept low prices for their product, whereas Suncor avoids that by using its own refining. It also wins thanks to having oil sands, which have incredibly long reserve lives and low decline rates. This means Suncor has oil production for decades to come from existing fields even if regulators and environmentalists block new oil development in Alberta. The company is tremendously profitable and sells for less than 7 times earnings. This is allowing it to pay down debt, buy back stock and offer a 4.3% dividend yield simultaneously. Banco de Chile. Banco de Chile is one of Chile's largest commercial banks. Chile has historically been the most stable and prosperous economy in Latin America, and investors have done well. However, the country's fortunes faded in the 2010s as persistently low commodity prices led to slow economic growth. That, in turn, fueled popular backlash and led to a left-wing government taking power earlier this year. Investors dumped Chilean stocks, sending them to exceptionally low valuations. However, the tide has now turned. Voters shot down a constitutional referendum which would have tilted the economy towards socialism. Following that defeat, the president was forced to shake up his cabinet, installing many moderates in a shift to the center. Commodities are rebounding as well. Chile's copper and lithium reserves are particularly valuable in a green energy future. Banco de Chile's outlook is rapidly brightening. Meanwhile, shares are at 6 times earnings and pay a 7.4% dividend yield. Pinnacle West Capital Corp. Up until recently, power utilities were one of the remaining safe havens in the market. However, they have tumbled in recent months thanks to rising interest rates. That makes sense, as utilities have tons of debt and will thus face higher interest costs going forward. But things have gotten out of hand. Arizona's Pinnacle West Capital, for example, has seen shares tumble about 20% between September and October. That's simply a massive move for a stable, regulated power utility such as this one. Changes in interest rates don't affect a company's valuation by that much. Pinnacle West is also the beneficiary of a great operating market. Arizona has been one of the country's most dynamic economies in recent years and will benefit from large new investments in the semiconductor and electric vehicle industries in the greater Phoenix area. Shares trade for less than 15 times forward earnings and yield 5.5%. Subscribe for more videos like this.